Welcome back to the Rise Trading channel. Today I'm going to be covering one of the most important concepts in Forex trading, which is of course risk management. I've broken it down into 6 separate stages and I'll be covering each stage briefly to give you a nice understanding of risk management so you can go on to keep your account and your hard-earned money safe. More importantly, to help you achieve long-term success in Forex. So, there's many reasons why new traders fail, and today I'm going to be covering one of the most common mistakes in trading and how you can avoid it. So let's get into it. So the 6 steps that I have for you today are protect your capital, use a stop loss, risk reward, risk percentage, stop loss movement, and hedging. And so a lot of you guys, all may seem simple, but please watch through the entire video and make sure you understand every form of the concept of risk management. So number 1 is, of course, protecting your capital. Why is this important? So protecting your capital is always the case for a new trader. This should be your main priority. You're never going to be fully profitable. You're never going to be consistent when you first start out. So the main thing that you need to do is make sure that you protect your capital and make sure you have money to trade with. And if you find that trading isn't for you, you can get out with the money that you have left. Now, not everyone can be an Instagram guru and never lose a trade. We all want our trade history to look exactly like this on screen, but realistically, it's going to look a little more like this. Now, this is actually the month for my account in December, as of recording this. So as you can see, I had a really bad month, and at the end of the day, I still made 7k in profit. Now, I'm not saying this to brag or to flex or anything like this. It's just to show how many losses I actually took. As you can see, USD Chafe, I had an 834 loss, which is 1%, and then 2000 is about the 2%. So usually on gold, I tend to risk 2% where I see fit, and we'll get onto this a bit later. 1,200. Again, it's never going to be bang on due to spreads, due to movement when you're actually placing the trade, but we get it as close to that percentage of risk as possible and maintain the consistency around it. So if we're looking at this big gold win, I got a nice 1.5%, and then I got an 11% win, which obviously set me up huge for the month. It probably would have saved it. Otherwise, I would have lost probably 4, 5, 6% throughout the entire month. Again, this is all because I managed risk and protected my capital. The big win is always around the corner, but you can never guarantee that you're going to win. Me, myself, been trading for 4 years and 10 months now, and this is what I've got. I'm still losing a lot of trades, but because I'm protecting my capital and managing risk properly, I'm still able to end up profitable. Of course, I have a bigger account, and it's not going to show if, say, you have a £500 account, it's not going to be the same. But we want to do exactly this, and this is what your average trade history should look like. Maybe a little bit better, but with good risk management, despite a poor win percentage, we can still end up profitable. To do this, I have some blueprints. So, ensure your trades make sense. This is really important when we're looking at an analysis standpoint. Never just take a trade because I think it's going to go up, or it looks like this, or someone said it. You should always make your own analysis and make sure the trades make sense to you based off what you've learned. If you haven't learned anything, please don't blindly follow anyone. Number 2, don't overtrade. Again, if you take a loss, don't just instantly fly into another trade because you want to make the money back, or don't keep taking trades when you're winning because eventually you will lose it and you don't want to give back to the markets. Which leads on to don't be greedy. If you're on a win streak, make sure you follow steps 1 and 2. Make sure they make sense. Don't overtrade. If you've had a good few winners for the week, maybe just leave it there and come back next week. And again, follow steps 1 and 2 again. Don't chase losses. So if you're on a loss streak, don't follow the loss. Or if you've took a loss on a trade, don't take an exact trade that's pretty much exactly the same with maybe a different stop loss, banking that your, say, gold, for example, will continue going bearish, but instead it goes bullish, vice versa, and stop trading when you feel like doing any of the above, except from step 1, of course, which you need to do. So take a break during your trading. On to step 2, always use a stop loss. Now, using a stop loss is a must. It's not an option. Using a stop loss, it has unlimited benefits and no real negatives. Sometimes you get stopped out and it goes in your direction, you'll be up, winning the trade. If you don't use one, yeah, it only works a certain amount of times until it doesn't, and your account is gone. That's not a real positive, so make sure you're always using a stop loss, because yes, sometimes not using a stop loss could result in a win, but it's not a real win because your analysis was wrong, your stop loss was in the wrong place. And again, if it does go against you, depending on when you stop yourself out, you could lose your entire account. And I get so many people messaging me saying, I've just blown my account. How do I recover from this? Back to basics. Use a stop loss. Don't chase trades, and make sure you're protecting that capital. Back to step one, yeah? Number 3, protecting your capital stops you from blowing your account, gives you specific risk amount, minimizes risk. So yeah, use a stop loss. There's no downfall to using a stop loss, and there's no real benefits from not using a stop loss. On to number 3, risk reward. Now, understand this is the key to consistency and profitability. The potential gain that you risk versus what you put up. So for example, if you risk £1,000, which you'll decipher by how big your stop loss is, this is how much you risk, and your gain is potentially £2,000 should your trade hit your target or your take profit. This is a 1-to-2 risk reward ratio. So what we got to realize is 1-to-1 on the left here is not really the most consistent way to make money. Yes, if you have a really high win percentage strategy, then 1-to-1 can be profitable. But for me personally, and I recommend most beginners to do this, is not to do 1-to-1s, because it can put a lot of stress on your mental and your psychology behind trading. Now, a 1-to-2 is a very good level. You have to win half your trades and still be profitable. And again, it just means if you lose 2 trades, you only have to win 1 to make it back. And it's just about managing that risk along the way. And for me, 1 to 3.5 or above is where you want to be putting your stop loss. So you never want to be moving your stop loss just to get the risk reward ratio up. You have to plan your trade first, mark where you'd put your stop loss and take profit, and then plan your risk, your lot size, after you've figured that out. So what you can use is a risk calculator, which basically makes you put in the pair, put in the stop loss, and put in your account size, and it'll tell you how much lot size you should be risking to make sure you only lose the set percentage that you plan to lose. And obviously from there, you'll be able to work out how much you're going to win should your trade hit take profit, which again, you should always be using this. It's not an option unless you get used to your lot sizes completely and you have the same account size for everything that you trade. But this is the difference in potentially a losing trader and a winning trader, is just managing your risk reward. As we can see in these examples, choosing a larger take profit, as long as it's realistic, can obviously make you a lot more money. But it's important to make sure your take profits are realistic and not stupid, because you could easily say, okay, my stop loss needs to be here to make sure I don't get stopped out, right? So how do I make this a profitable trade? Let me just say your stop loss had to be huge, 40 pips, which is quite big for me. Certain traders and strategies may think 40 pips is quite a tight stop loss. All depends on the strategy. But for me, 40 pips is big. To get even a 1-to-2, I'd need 80 pips profit, which my average profit range is probably about 40 to 50 pips. So having a 40 pip stop loss, just to get a 1-to-3, I would need 120 pips take profit, which again, like I've just said, my average win's 40 to 50 pips. Having a 120 pip take profit is very, very unrealistic for me. Therefore, I wouldn't take that trade if the stop loss were to be that big. Now, your analysis is the most important part about this. Never change your analysis or strategy for risk reward. Like I've just said, if you find a trade that's below your ideal risk reward ratio, don't force it. Don't move the stop loss. Don't extend the take profit. Mark where you would usually take the trade. Say you're going to enter at a certain level and your stop loss is there and your take profit's there. If it doesn't make sense, which again goes back to protecting your capital, if your trade doesn't make sense, don't take it. So it all comes back to your analysis. So if that happens, move on to the next trade and be patient. The best traders have the ability to sit on their hands and only take the trades that make sense whilst sitting on their hands. So, step 4 is risk percentage. Now, this one's quite important. It should depend on stop loss, like I've just said. Should never be higher than what you state in your plan. Suggest 2% maximum risk and should be done using a risk calculator. So you have to have consistent risk. Again, I know in my screenshot it's slightly different, but on gold I tend to take a 2% risk, and on normal Forex pairs I tend to take a 1% risk. For me, this works out, but again, it's consistent for me because my gold win rate is higher than my Forex win rate. So again, you should never, when you write a trading plan, if you need a video on a trading plan, let me know in the comments down below and I will get this made for you as soon as I can. Should never break your plan or your strategy. Always follow what you've written down on paper, and again, should be done using a risk calculator, which I will show you right now. So we're on the charts. For example, this is the trade that I've marked out. Okay, there's no real logic to it. I've literally just brought it up and put it in there. Let's just shrink the stop loss. Actually, no, let's just leave the stop loss there. So that's where I wanted my stop loss to be, for example. Cleared to make sure we don't get tapped out on this inefficiency level. My take profit is at the open of this order block, which is again when the inefficiency will be filled. So these are my levels. So you can see I've got a 3.5 risk reward ratio, or 3.48 give or take, and my stop loss is 28 pips, and my take profit is 980 pips. So what we do is we head over to my Forex calculator, which I'll leave a link in the description down below if you need it. And again, this matches the plan, 3.5 risk ratio, give or take. I'm happy to take this trade. So now the trade makes sense. I'm going to go find out what I need to be risking. Now that we're on my FXbook Forex calculator, it's very straightforward. We just need to fill in the blanks basically. So I'm trading XAU USD, which is gold, account currency, let's just say GBP since I'm British, £100,000 in the account, let's just say. I want to risk 2% because that's what I've written in my plan, and the stop loss was 28 pips. So if I press calculate, again, at the bottom here, we can see the lot size I should be using, and the risk should be £2,000. I should be using 86 pips. 86 lots, sorry. But one thing to note on XAU USD, it actually uses the commodity pips, so it needs to be 280 pips stop loss, except even though in Forex terms it's 28 pips. So that would be an 8.64 lots. And now what I would do is go over to MetaTrader or CTrader or whatever platform you're using to trade, enter 8.64 lots. I would go in with my buy, enter my stop loss, enter my take profit. Now if I win, I get the 3.5%, which in this case, well, I'd get 3.5 risk reward ratio, and then I'd earn £7,000. If I lose £2,000. So that is essentially what you should be doing for every single trade. There are no exceptions. You should be managing your risk, and you should be doing this for every single trade. Now, back to the slideshow. Let's get on to step 5, which is stop loss movement. Now, this is really important, and it can really enhance your trading career and enhance your risk management level. Yes, it's very basic, but it's very, very important. The thing is, whenever someone says they've blown their account and I say, do you know about these concepts? I say, yes, but you need to be doing them, otherwise you're going to fail in trading. It's that simple. So, stop loss movement. The first one would be stop loss to break even. For example, this is where I started my trade. This is my stop loss, this is my take profit. It's probably a healthy 1 to 4 or 1 to 3.5. And we're looking at this. When trade goes into profit and 50% towards my target, then, or whatever's in your plan, right? People say when I'm 10 pips up, or there's loads of different parameters people use, right? Whether it's touch break even already and then continues in your direction, then you move it to stop loss when it makes a new low. There's endless opportunities to move your stop loss, right? For me, in this example, I moved it when trade hit 50% towards my target, right? You set yourself a rule when you would move your stop loss to break even. When this is hit, move your stop loss to your entry point. And what this does, is when price comes back down, you would only lose spread and swap fees, and that's it, right? You're limiting the amount of loss. So regardless of what happens in this trade, you're not losing much money. It's very minimal in comparison to the account. It just keeps you safe. For example, if you were taking a trade at night and then you went to sleep afterwards and you've lost 1%, or you could just make sure you secure your profits at break even. It's important not to do this too early and make sure you follow the plan. Again, you always should be following your plan. But for example, if price just starts moving and you've had too many losses, so you just want to make sure you don't lose again, and you move stop loss to break even, and then what happens after that? Price flies in the direction you want it to, right? So you've got to set a plan that works for your strategy and understand when you personally are going to move your stop loss to break even. Now, the next step on this is indeed hedging. Now, hedging is a very complex, complex concept. When you've been doing trading for a while and you understand the markets, it can be very useful and very powerful. But as a beginner, I would recommend avoiding this and looking into it in the future. Again, if you want a video like this, let me know in the comments down below and I'll get to making it for you. So hedging is complex risk management, but can be extremely profitable if done correctly. What hedging looks like is basically this, okay? So you're buying and selling the same asset or the same pair. In this scenario, I entered my buy from this area here, for example, and price started to fly upwards. Let's say this is 100 pips here, okay? At this point, this is 100 pips, and I'm aware that this broke structure here. So we got our change in character for my strategy. So what happens at this point? I take a sell as well because I get confirmation within here. My stop loss is above the high over here, and now we're selling. Say this stop loss is slightly bigger than this stop loss, but again, regardless of what happens, we're banking pips. So here we were at 100 pips, now we're at 30 pips on the buy at this point, but this one is now at, say, 60 pips on the sell. Obviously, these don't match up because the stop losses aren't the same size. Remember what we were saying about risk percentage, but it's still protecting your capital. So for example, if price continue to fly, at this point, I'd be at break even in this trade, right? Because it's a hedge. That's the goal, to make sure you hit break even as soon as possible. When price is coming all the way down, I'm putting this to break even. At this point, this trade's already at break even, right? So regardless of what triggers, the buy or the sell, I can't lose money now. I'm in profit regardless. So if price flew all the way down here, I don't lose any. Obviously, I'm break even on the buys, and I'm like, I don't have to worry about the profits that I've just gave back to the market because I'm still profitable in this sell. Same here. If price just continue pushing bullish, which obviously I expected it to at this point, I would take a break even on this short here, and then price would continue to fly up. Yes, in a very odd case or a very rare scenario, you might hit stop loss here and hit stop loss here. But again, as long as both are at break even, you wouldn't lose any money. It's just an extra method to make sure that you bank more profits and ensure long-term profitability. In terms of managing risk, how is this managing risk? When you enter in the market at pinpoint precision and you're understanding, you have full confidence in your strategy, you can really make use of this just to make sure that when price is going against you for potentially to break even, you can still bank some profits, right? If price comes all the way down to this level and I break even on my buy, maybe I decide to close my sell and still take 4% here, or 1 to 4, or whatever it is. Obviously, this is just rough gauging, but again, we're making sure we're banking profits along the way and not giving back to the market. So hedging. The goals of hedging is to get stop loss to break even in both the hedge and the original trade, to protect capital and to maximize profits. So that brings us to the end of my risk management guide. If you want any in-depth videos based off what I've discussed today, please let me know in the comments down below. Reach out to us on the socials. The links will be in the description, including my FX book Forex calculator. Other than that, I hope you enjoyed the video, hope you learned something, and hope it was useful. Please subscribe and like, and I shall catch you all in the next video.